Hello everyone, my name is Rob Ellis with Section 8 Launch, and today we're going to be diving into a very deep analysis that we did over the past 3 months. We have looked at Section 8 as a whole across the entire United States. We analyzed more than 26,166 zip codes. You guys can find this report on our website under Section 8 Market Report, section8launch.com/Section 8 Market Report. This is the full market breakdown. And a lot of people are going to ask, most investors, when they're looking for rental properties, when they're looking to get started, they're going to say, what's the best Section 8 market this year? Or where should I be looking? What types of properties? We personally believe that the better question to ask is, where can I find strong government-backed rent potential relative to the acquisition cost while still avoiding markets that are cheap for a reason? So after looking at the nationwide data set, this is kind of what we found. These are the quick ones. The top 500 markets, so top 500 zip codes, had a rent spread of 21%. If you take the annual rent times 12, a 4-bedroom rent times 12, divided by the acquisition price, you're going to get this. The top market that we saw by clustering is St. Louis, Missouri, and Illinois. The top city is Detroit, Michigan, and the top county in the entire United States is Bertie County. Now, here is how the analysis was built. How did we kind of look through this and kind of come up with everything? So the first one is it's a screening framework. This is not meant to tell you where to buy rental properties. It's meant to compare markets and help you look at them. You can see right here, we took the 2026 4-bedroom SAFMR monthly rent times 12 and divided it by the Zillow ZHVI single family home value, which comes out every year. That's going to give you the annual rent to value spread. The county assessor reports, and we're using these to separate them and kind of benchmark them against each other. We're using public data and private market listings and history to create those. We created a scoring system, which is kind of proprietary, but it's meant to just help us do it. This is based on our HUD API integration, which is public data that allows us to access all of these. Here is what we found from the biggest 26,166 zip codes that we analyzed. These are the main things that we found, and we're going to show you guys a lot more detailed data. But the biggest discovery was this. The strongest metro cluster was St. Louis, Missouri, and we'll get into our reasoning behind that. The second finding was that in terms of a county, Bertie County was the number 2. What we said is that cluster strength matters more than one zip code. So if you want long-term longevity, in my opinion, you want to look at the metro populations. You want to look at a lot of other factors like schools, local knowledge, contractors, and everything else. This is why you work with a team. We're putting this report out every year so that you can understand what kinds of markets we're ranking and why, and where you can already separate yourselves. If there's a market that you can be 20% more efficient in, that's the point. So here's what we see. Metropolitan statistics. Top metro clusters by opportunity score. So we score these on a weighted scale. St. Louis is going to give you number 1, Missouri. Helena, West Helena, Arkansas. Detroit is going to be number 3. Pittsburgh, Pennsylvania is the number 4 market. This is based for investors that want more than just one zip code. They're looking at inventory, teams, lenders, contractors, macroeconomics, which we think are a lot more important than just one. After that, you're going to get Greenville, Mississippi, Charleston, West Virginia, Johnstown, Pennsylvania, Youngstown, Ohio, Warren, right? Jackson, Mississippi, Louisiana, Birmingham, Alabama, and Memphis, Tennessee. This shows you how we created the scores. So St. Louis, Missouri, for example, has an average spread of 11. The median is 8. And these gives the values. And the number of zips in the top 100 and top 500 are what drive a lot of this weight, right? And the average 4 bedrooms. So there are metros that have much higher, like Memphis, And there are metros that have much lower, depending on where they're at and what's realistic. There are metros that average more than $2,000 a month for a 4-bedroom max payment voucher in that area. We're looking at the max spread as well in that area. So you can see Arkansas here, Helena, West Helena, Arkansas. You're going to see 2 and 5 in the top. But again, we're clustering it based on the average one. So you can see the price point's a lot lower here. In St. Louis, you have a lot stronger metro. And then you get the Detroit. So a lot of our weights are looking at larger data sets with big metros like Detroit, Warren, and Dearborn, Michigan, which have always been great. When you look across the board, you can start to see like, okay, if the average home is there, then there's going to be lift from the market as well as job stability, how many Fortune 500 companies are based out of there. There's a lot of different weighing factors that you can put here. I really like the higher 4-bedroom spreads than the lower ones. So for me, I look at more at these. And again, I think the number of zip codes that you see in the top 100 and top 500. So Detroit has a lot. Pittsburgh, Pennsylvania. You're going to see a big representation of the Midwest in here. What gets these down further is going to be decreasing amounts as well as not so many zips in the top 100. If you look at these by city, this is not just metro but city. We're going to do drill downs beyond macro to identify localized. So our city level assessment is more regulatory environments, localized demand, and more of the actual city clusters itself, right? So you're going to see a lot bigger one. Detroit, 25 zip codes. The average spread is 24%. The median, the max is almost 40. You can see the median Zillow home value is 83,000. So if you like coming in, you can see where these are all coming in the city metros in the average 4-bedroom. This is going to be a lot stronger. So Johnstown, PA, they're not all of these are a little bit different. This is more concentrated just inside of the city limits. Youngstown, Jackson, Mississippi, Flint, Michigan, St. Louis, Missouri. So you still see a lot of the same representations, but if you're looking for more of the city limits and consistency, and depending on how the Metropolitan Housing Authority is in that area, we looked at more than 400 municipalities, looked at the velocity, and compared it to the regulatory friction. This goes all the way across to the median home value, the average 4-bedroom rent, how many zips are in the top 100, top 500, and again, we're going to create an average score of what we're looking at in that city. So when you look at the city analysis across the board for these types of Section 8 metros, the top one you're going to see here is Detroit, Michigan. Second is Johnstown, Pennsylvania. Third is Youngstown, Ohio. Now, why would you separate metro from city? Metro is going to be a bigger representation. It's going to give you a wider spread, more zip codes. It's going to let you kind of extrapolate out. A city limits is a little bit different. So just two different ways of looking at the same data. And then we also looked at county level data as well. Now, the county level data is a little bit different. This is the by county, how many zips are in the top, and more of like the max spreads. You can see how these come down here. So you can see the median home values. Like if you look at Wayne County, which is up in Michigan, compared to Berkeley County in Virginia, the average entry point of a single family home is much different than, and the 4-bedroom spreads are the greatest. So on this one, when you're looking at a county level, we are also separating it out in the same weight, but we're looking at it from a different perspective. So Wayne County, Tillman County, Knott County. Again, a lot of these are going to be in the same areas, and you can see kind of here. So depending on how much risk you're giving them, these are meant to be screening processes across the board. The top 50 zips, this is probably the most useful data, and this is because of the spread percentages. So this is raw spreads. And this is going to give you a lot of the counties. So Berkeley County, North Carolina. This is one of my favorites. So you got the 5-digit. You've got the city, the state. This is the outlier right here, right, where you can enter. So you can look at these, look at the listings that are over here, see what things are going for. Bakersfield, California, right? You can see how high the 4-bedroom is paying, $3,300, and how much the Zillow home value is in the spread. So there are this one particular zip code out in Bakersfield has extremely high Section 8 vouchers for a 4-bedroom. So if you're in California and you want to look to try to stay at, you can also look at your stay here to see, okay, can I somehow, let's say I'm in Florida, right? I'm looking up top to bottom. I don't see any of my state in the top. So then I'm going to start looking at concentrations. Okay, there's some Illinois. Again, you're going to see St. Louis, Missouri and Illinois kind of pockets there. You're going to see a lot of North Carolina, California. So this is going to give you that. And that's why we're seeing St. Louis kind of cluster towards the top. Again, the main thing that we're looking at is the 12-month. So if you're looking at Bakersfield, California, or some of the other ones, most of these vouchers you're going to see are in the 1,000. If you want to see the distribution, Baltimore is another really high price point, which is one of our favorites as well. There's a couple zips in here that outperform right here, where the vouchers are very high compared to the entry point. So if you're wanting more, if you're wanting the highest, this means that this would almost pay itself back in year by a gross rent multiplier. So this is a very easy way to look at these. But looking at this one top to bottom, you're going to see a lot of the same areas. St. Louis, Missouri, Flint, Michigan. Again, St. Louis, Missouri. Bertie County's been kind of taking it away. Lots of Pennsylvania and Arkansas, Johnstown, and Pottsville. So you'll see a lot of these. Youngstown. So we're looking at under the market and then also compared to the zip code, right? So in Ohio, if you're looking by state, you can say, okay, Youngstown is the best one in Ohio. If you're looking in Mississippi, you can scroll down until you kind of hit one of the top. Jackson appears here, which again is going to show the largest spreads. We have individual pages built out for these as well. But if someone says, for example, Toledo is one of the best Section 8 markets, and I look at here, I'm going to say, what would you have that would back that up? That data, right? I don't see it in the top 50 zip codes, not even one in that city. And in my personal opinion, if you look at the top ranking metros across the board, they're always going to have high representations across the top 50 levels as well. This is as granular as we get. This is the technical kind of approach to everything. So you're going to see, again, a lot of Illinois, Michigan, Missouri. You see North Carolina, West Virginia, Pennsylvania, Arkansas, Ohio. These have always been big states. Kentucky, again, more Missouri, Oklahoma. So this is Temple, and you can see kind of the breakout. So when you look at these, there's some varying. When you look at the high level and you say, okay, well, why would Jackson, Mississippi be worse than St. Louis, Missouri? That's going to come down to the team that you're working with and the markets that you're selecting. So the whole point of this is to screen out and to show you where you can possibly do it. And if you want to compare different markets, like, okay, how does St. Louis, Missouri for Section 8 rentals compare to, let's say, West Helena, Arkansas, then you're going to start looking at some of these. So it looks like a lower entry point, obviously, but it might be a smaller metro. So as you start to look at the more technical data, this is going to be one of the best that you can have access to. For us, St. Louis ranked as the top because it had more than 200 zips, 12 top 100, and 22 top 400, and a max spread is 62. These are the different markets. So why would I go to St. Louis, right? What the data says is that the opportunity is very wide across many zips instead of isolation. A lot of investors like it because it's a broad set of investable zips across the entire metro. When you look at what could go wrong, you want to be looking at several of them would require deep local knowledge and careful neighborhood selection. Because there is so much, how do you know within the city? But if you want long-term scale, this is one of the best markets. In my opinion, number one, depending on age of home and your comfort level for renovations. Investors with a strong local operations team and underwriting, which is where a lot of the times we come in, are going to be doing it. If you should avoid if you lag neighborhood level sourcing or you don't have any kind of management experience. If you want help evaluating that market, reach out to us. The second one that we like is Detroit. Detroit ranks high because it has a very high percentage in the top 25 zips. The average spread's 24%. The median's 24, and it has 17 in the top 500. A lot of investors are going to like this because it has upside relative to the entry point. It's also legacy and industrial manufacturing and a tier 1 metro, which means you have a lot of data sets and a lot of historical things going for it. The upside is in the entry point. What could go wrong is block by block, property condition, insurance, taxes, and management. It's best for investors who are looking at the street by street level and can manage the intensity of Detroit housing. You should avoid Detroit if you can't manage the block by block operations or have anyone that's in there. Again, if you want help looking at Detroit, let us know. When we look at Pittsburgh, Pittsburgh is also one of the highest ranked metros, more than 294 zips that we looked at, and it was a 10% median. The appeal is in the breadth and affordability. It's also the Midwest and a tier 1 market. Not every zip is going to be equal. or as operationally as strong, but it's good for investors seeking portfolio diversification over in many submarkets. Jackson, Mississippi is one of my favorites because of the housing stock. It's so new. It is a smaller metro. I wouldn't say it's huge, but it did show up as several of the top. It has 48 metro zips we looked at 9 city zips and the max spread of 37. Very affordable and great rent to value spread. It's also pretty isolated. You're going to be looking at local execution and a lot of micro data depending on each one. Every place, like in Jackson, you might have a lower floodplain, but the homes are a lot newer. So when you're looking at Jackson, they're going to be 50s, 60s compared to other markets, right? Youngstown also showed up as a strong market because as a metro and city cluster, the data says that the city is 25%. On average, the median is 24 and the highest is 42. Very low entry point. That's why investors would like it. What could go wrong is liquidity, condition, and neighborhood selection. It's best for value investors looking for the biggest discounts. You might also have trouble with lending if you're over here too. So if you want active asset management, if you need a fast resale or passive hold, I would not be going here. If you want a more stable entry point with 4 bedrooms, and then you want to look at metros with a little bit higher. Okay. Shreveport had several high-ranking zips. The max spread was 49% and multiple strong zip codes on the lower end. Strong rent-to-value ratio. What could go wrong is some high-spread zips may require very close underwriting. It's best for those with very disciplined underwriting and local operational partners. If you can't conserve underwriting or conservatively underwrite, I would not be looking at that. When you look at Birmingham, Birmingham has ranked as a top city cluster. It only has 15 zips and a little bit lower spread. A lot of investors like this because it's a southern market with strong rental demand and a great sub-market. There are a lot of dispersion and varying neighborhood quality, so you're always going to want local knowledge. When you're looking at the southern markets with rental demand, that's one of the best ones. You would lump in Jackson, Mississippi, and some other ones. You should avoid them if you can't underwrite at the sub-market level. For Flint, Michigan, we have a very high spread of the max spread of 49% and the average of 26. It's very affordable compared to the rent, and operational intensity, condition, and market level risk are going to be what could possibly go wrong. This is good for investors who are prepared for hands-on management and rehab in Flint market. You should avoid if you are wanting to avoid high operational demands. Toledo's a great city as well. Again, 15 zips. 16 and 15% on average and median, and more than 31% on the max. A lot of people like this for the affordable Midwest market. If you want a high presence in one market, if you want to be multiple diversified, Toledo, Ohio is one of the better ones because Ohio does have several markets that appear in the top 25. Again, looking at the possible submarkets here, people really like the affordable entry point here, and there also are some good opportunities, but again, that local selection is going to be a problem. For Baltimore, one of my favorite markets, Baltimore ranked as one of the highest city clusters. The average spread is 17%, median 15%, but has a very high 4-bedroom at $26.84. People like this because it is a tier 1 East Coast market with a very high rent level. Block by block level and local regulations can change things. These are great for investors targeting high rent city opportunities and economics. That can also look at the local economics, but you should avoid it if the block by block level variation or local regulatory complexities are going to come after you. Again, if you want to help looking at Baltimore, please reach out. We'd be happy to help you. In terms of Cleveland, another great market. What we see in Cleveland is an older houser stock. So for Section 8 rentals or rental properties in general, you're going to want to look at the overall. It ranked several in the top 15. The data says that the median and average are pretty close to 17%. The average 4-bedroom is $17.33. They might like the great affordability and strong existing investor interest. There's a lot more competition, I would say. As far as submarket selection and execution, that's what could possibly go wrong because of obviously how wide Cleveland's metro is. This is good for investors that want to compete in markets with a strong existing capital, but you should avoid it if you don't want to look at the submarkets or execute locally. It's a much larger market. Now, what we say is this. When you look at all these spreads, the highest spread for Section 8 rentals does not mean it's going to be the best investment. The myth here is that the cheapest house with the highest rent-to-value spread is going to be the best, but that's not always true. Sometimes it's cheap because of the neighborhood. It might be higher operations. The conditions are worse. Insurance can be higher. The tenant base might be thinner or higher competition, or the exit strategy can be weaker. There are a lot of different inputs that can affect which market you would want to go into. Crime, taxes, insurance, the property condition, what types of inspection risks there are, rent reasonableness. So that means, like, in terms of rent, where can we expect it to land, right? So are there a lot of vouchers? Are there high spreads? Is there a lot of competition? Vacancy can push a lot of it. One of the biggest is property management quality and contractor reliability. You do not want to be getting into a project that you're not necessarily comfortable with. So a lot of people come to us saying, how do I get started? And we say, well, start with market rankings, and I'll get that to that below, and then start to look at that. If this is a little bit outside of your comfort zone, then what you want to do is work with a team that can help you with that. Some of the other factors that can impact is neighborhood liquidity, exit strategy, and local housing authority rules. When you adjust risk, the goal is not to buy the highest spreads. The goal is to match the right market for you, the right property for you, the right financing for you, the right management for you, and the right execution for you. If it's local for you, maybe that's what you're looking for. You're in Pennsylvania, you like the ability to be able to drive an hour or two. That strategy might be different than someone that's in California and wants to acquire the most properties. And that even might be different than somebody who wants to aggressively build a portfolio through refinancing. When you work with our team and others, you should be modeling sustainable operational margins, applying predictive maintenance schedules, and calculating risk-adjusted cap rates. Now, a lot of people would ask me, if you had $100,000 for cash flow, how would you think about growing? Most investors are looking at random market opinions. They don't have a framework that we're relying on. If you had $100,000, first of all, my goal would be to look at capital preservation and comfort level. Single family detached homes. I like homes built up to the 50s. I like higher spreads and higher rents. But the biggest thing I like is ranch, slab on grade, no basements, no complexities. A lot of the weights that you're going to be looking at is the right strategy. It's going to be looking at your capital, your credit, your timeline, your risk tolerance, right? And how much you can be involved. And do you have a team, yourself, locally, or with one that we match you with, if they can help you with that. The mistake is trying to maximize your properties instead of maximizing the probability that the first few deals will actually work. So if you want help with $100,000 plan, please book a strategy call on our site. For a conservative strategy, I would look at one property in a better neighborhood. I'd be focusing on higher cash reserves. I would be slower to scale with lower operational stress, and the best for first-time or risk-sensitive investors. If you want a balanced strategy, which means I'm looking for my first 1 to 2 properties in the next 6 months, you want to look at a data-backed market selection, what we're showing you here. Then you would want to be looking to talk to property management that's already working with a lot of units, has a lot under place. There's a lot of demand for it. They have strong contracting teams. This is going to be best for investors who want growth without overextending themselves and strong reserves. If you want the most aggressive strategy and you're looking for the highest cash flow, that would be 2 to 3 lower entry assets. It might be all cash acquisitions. You're looking to do portfolio loans and scale aggressively. You're looking for light operational risk with more refinance on management and contractors, more reliance on them. So this is going to be best for strong investors with strong reserves and real execution support. So if you're working with us with an aggressive strategy, or you have a certain number, or you're 3 years from retirement, or you want to get to $10,000 of passive income a month, this may be a good strategy for you if you're a little bit more on the aggressive side. This is a scaling methodology that we have. So there's a simple 1, 3, and 5 year for the 100,000. Most investors are going to fail because they look at each property as a one-off decision. But what we look at it when we're building a market plan is to build a repeatable portfolio system where you can scale like an institution. Year 1, you're going to be looking at the right market. We're matching the market to you, going through, introducing you to teams in your first 2 to 3 weeks. The first one is looking at your first assets. So acquisition. Do you have a large rehab or a small rehab? Do you want 3, 4 bedrooms? Do you want ranch homes? Do you want row homes? Do you want high rents or lower rents? Are you trying to invest close to home, or are you comfortable investing far away. The next thing is going to be validating the operational model in your first year, which means working with a strong management team, making sure that you're comfortable with them, making sure you understand how tenant placement works and all the economics. As you feel more comfortable and management stabilizes, you're going to learn the real numbers and start scaling. Over time, as you go years 2 and years 3, you're looking at owning multiple properties, improving your financing knowledge and types of financing opportunities. Like I said, portfolio loans, DSCR, on a BRRRR or buy, rehab, rent, refinance, repeat. You're going to be looking at those types of opportunities. You're looking at minimum thresholds for lending, a lot more technical. So if you're in a scaling position, this is probably where you're going to be at. And some people hit this part of their growth earlier on. After that, you're going to be looking to reinvest your cash flow, refine your market selection, possibly expand to more than one, and build scalable systems. As you continue to grow, whether it's in year 3 or when you're ready, we're going to look at operating a stronger portfolio, improving your cash flow consistency, which means if you had a project that isn't doing as well, liquidating or selling assets that are underperforming, starting to look at it as more of an asset management position. What can I do with these? Should I lower my debt? Looking at the levers that you can pull to increase. One of the other things you can do is having cleaner management or multiple management teams. Having depth in a market. You might have market rate, Section 8, and Airbnb. So market selection based on that. You're going to create better exit options for yourself. Maybe you're packaging up bundles of homes and selling them out and doing 1031s. You're moving from random deals to portfolio strategy, which is our target. Overall, this is what we try to do. When you're coming in as no matter where you're at, whether it's a first-time professional working, you're trying to leave your job, you're trying to build a passive portfolio, in 10 to 12 questions working with us by booking a strategy call, we are happy to help you out. A lot of investors ask these questions, right? How do you look at institutions? How does an institution look at this? That's where we come in. We have all the data. We've looked at all the data. After 12 years in real estate, our focus for people that work with our team at Section 8 Launch is to review methodology, data preference, and match a market to you and match a housing type to you. So you might ask, how current is the underlying data that you guys have? We use these based on a monthly basis. We update every 6 months. This is 2026 data that pulls it all in from not only Zillow, but also the max rents, voucher payments down to the zip code. How do you quantify investment risk in specific clusters? When we look at risk, it's calculated using a multi-factor model that accounts for historical vacancies, localized housing authority and vouchers, macroeconomic shifts, availability of metro population and jobs, crime, and lots of other ones. You can probably do it well on yourself, but it just comes down to research. Are changes to HUD payment standards tracked dynamically? The answer is yes. We always keep a track of this. We update it. We do it by the MSAs and also by the zip codes. This allows us to forecast models that are based more on technical approach at the municipal level. Does this report cover granular zip code level insights? Yes. When we come in, we're looking at high level, but we also use local housing reports, local market knowledge, local MLSs that publish how those are appreciating. And within even a market, across 200 zip codes, you can get very different results by entering those various markets. So we start to look at a sub-market data if you end up going into larger metro populations of more than 1 million people, but if not, no big deal. You can access this by requesting at the bottom of the page or by just watching our YouTube or short forms or by booking a call with us. So Section 8 Launch, this is a little bit about us. We help serious investors evaluate markets, analyze opportunities, and build a portfolio plan around their capital, credit, and timeline. We also look at their risk tolerances and match them to the market. If you want help choosing the right market, hop on a call, book a strategy call on our site, reach out on our YouTube, anywhere that you guys are at. These are our top markets. You guys can see some of these. And again, a disclaimer that this page is for educational and market research purposes only. It is not financial, legal, tax, or investment advice. This market data is a screening tool and should be validated with local underwriting, property level due diligence, lender reviews, insurance, property management, and local housing authority requirements, as well as advisory for us. So I hope you guys enjoyed the video. This is a full page that you guys can access at any time. Again, my favorite portion is this right here, which is all of the top zip codes that we have access to across the board.